Hello and welcome to my video. My name is Mark Parham. I'm an entrepreneur and property investor, and in this video we're going to be discussing all the different asset classes that you might want to consider as an investor. We're also going to go through how much I have in each area and what weightings I'm working to, so you'll get a good idea of what my portfolio looks like. But before we get into the video, if you'd like to have a one-to-one chat with me before I get to 1,000 subscribers, have a look in the description. There'll be a link. Fill out the short form and you can book a one-to-one call with me. I've done about 35 so far. I've really enjoyed each and every one, so please book yours while we can. Anyway, let's get into the video and let's go through property first of all, because anybody who knows me knows I love property. I've got about £3 million worth, and it's all throughout the UK, so I'm not geographically tied to one area. I'm also not particularly tied to one strategy, as I have single lets, HMOs and service accommodation, so I'm pretty well diversified in the property industry. So let's go through a little bit about property, and let's start off with the positives, because I'm a positive person. The first thing I'd say is it's stable. Now, if you take a short-term view, you could argue it's not stable, but on a long-term view, i.e. 10 years, it's an incredibly stable asset class. If you want to have a look at the property index, the best place to go is the ONS, the Office for National Statistics, and you can get a really good idea of both regional breakdowns as well as national guidance for property prices at any one point in time. Next thing I love about property is the fact that you can apply leverage, and I really love this fact. You can't really apply leverage to stocks and shares, index funds or Bitcoin in the same way because the banks see property as such a safe investment. So let me explain what the leverage is in property. So if you buy a £100,000 property and you put down a £25,000 deposit, the bank will lend you £75,000 to cover the rest of the difference and take what's known as a first charge on the property. This is a mortgage, it's a normal mortgage arrangement. So what does this mean for you? Well, you own all the property. The bank doesn't own 75% of the property, but you also owe all the debt. So it's important to say that leverage works in both directions, and this is how negative equity can happen. Over a long period, it's incredibly unlikely that that would be the case, as property always tends to rise and we live in an inflationary economy, but there's no guarantees to this because leverage works in both directions, so you need to be aware of that. But if the property followed the long-term trend and doubled in value in 10 years, your property would be worth $200,000 and your debt would still be worth $75,000, assuming you had it on an interest-only mortgage. So you can see how leverage can work in your favour there because you make £100,000 profit. The next thing I love about property is rent and capital. You get paid twice, you get paid once in rent and once in capital, and you get to affect the outcome on both occasions. So I've put up here that you can achieve a 15% ROI. But I believe you can achieve that by throwing a dart at a dartboard and just being a little bit clever. Now, if you start being really clever and buying below market value and negotiating the price, and you start looking at ways to increase your rent like HMOs, you can achieve closer to 30-35% ROI, all the way up to an infinite ROI if you use BRRR and get your money back out. There's lots of things you can do with property that are a little bit smarter than you can do with other asset classes. So I love property, as you can tell. There are some negatives though, obviously. Now the first one is it's completely illiquid. You can't sell it tomorrow. Very, very hard to sell a property tomorrow. Even to put another charge on a property tomorrow, it'd be very difficult to raise funds. I understand that for some people getting a mortgage might be hard. Now, especially if you're a first-time landlord, if you go and ask a bank for a first-time mortgage on a big HMO and you've never been a landlord before, you're probably going to have some problems. But for me, as a portfolio landlord, and I can assure you, as you grow your portfolio, it becomes much easier. They don't look at you as an individual and they start looking at the deals only. The next thing would be the management, and there is management for this. It's not completely passive. Even if you have a management team in place, you have to manage the managers. You're still going to have to do mortgages yourself. You're still going to have to deal with the solicitors yourself. So there's lots of management involved. Not so much that it's not worthwhile, but be aware that it's there. And the last thing is it's expensive. Now you can start in stocks and shares for £1, start in index funds for £1, Bitcoin for £1, property, 25 grand. Realistically, it's expensive in comparison using a traditional buy-to-let HMO kind of model. That said, property is still one of my favourite asset classes and I have over £3 million worth. So let's move on to stocks and shares, and I'm actually going to include bonds over here as well. And we're going to talk about bonds as well. Let's put bonds on here. So let me give you the simple version of stocks and shares and bonds, okay? So stocks and shares are when you purchase a slice of a company. So for example, you may be able to purchase £100 worth of Apple stock, and then you'll own £100 worth of the company. Now, a bond is where you purchase the debt of the company or the government. So this is generally a fixed interest rate, whereas stocks and shares, they tend to pay a dividend. So when the company makes a profit, it pays a dividend and you receive your part of that dividend. Now, index funds are made up of stocks and shares. Let's say, for example, the S&P 500. So if you were to buy the S&P 500 index fund, you would buy a slice of Apple, a slice of Facebook, a slice of Tesla, a slice of Google, all these big companies, and the top 5 companies I think make up about 20% of the S&P 500, and you buy it in that relevant weighting. So what are the benefits and negatives of both of these two things? So stocks and shares, first of all, the big positive is it's very, very liquid. When you're dealing with publicly traded companies, you can buy and sell instantly. It's extremely passive. I mean, you have no say over how Apple is run on the day-to-day. You're entitled to go to a shareholder meeting and you're entitled to vote for shareholder rights, but it's completely passive and it's extremely easy for you to trade and cheap to get into, right? You can buy £1 worth. Now, on the negative side, it is risky, okay? So an individual company can go all the way to zero, and there's no leverage available apart from using things like CFDs, but this is really trading rather than investing. So we won't focus on that in this beginner's guide. Same applies with bonds. The reality is they're very liquid. You can sell and trade bonds very easily, extremely passive. You do nothing and extremely easy to buy, and at the same time, very risky because in a sense, if the company goes bust and it can't pay its debts, then the bond is junk, and there's no leverage available for any of these things. So the index funds take some of the risk away because by clumping all the 500 companies together, they won't all go bust. It's not going to be possible for that to happen. If individual companies start to fail, the index fund sells them off, and the companies that are doing well, it buys more of. So the index fund constantly adjusts itself to give you the best possible portfolio. So it's accepted that index funds tend to outperform over a long period of time. In fact, there was a study recently of hedge fund managers over a 10-year period versus the S&P 500, and it was a very, very, very small amount. I think it was 2% managed to outperform the S&P index funds. I personally invest in index funds over stocks and shares. So in terms of my portfolio, obviously I own private companies and those are different, and I've got 7 figures worth of private companies. I've probably got about 10 to 15 grand of stocks and shares in some particular companies that I'm interested in. And then index fund, I've got a couple of £100,000 worth of index funds. And that's where I tend to put my money if I'm investing in the stock market. Lastly, we've got Bitcoin, okay? So Bitcoin and crypto, it's a much wider market than just Bitcoin, but Bitcoin is the #1 cryptocurrency, I think we could agree. Now, I held Bitcoin for a long period of time and I did a video on that, and recently in December, I sold all of my Bitcoin to purchase another property. So at the moment, I have no money in Bitcoin whatsoever, and I don't think I will unless we see a big crash, in which case I might try and pick up some at the very bottom. I kind of understand that it's a very, very risky asset, and because there's these huge swings, huge losses and huge returns are available. So that's a negative and a positive. On the positive side also, it's easy to buy, but negative, it's very unstable. So it doesn't really act as a good store of value. You can't predict where it's going to be in the future. You can't look at its long-term trends. So for me, Bitcoin's more of a gamble than it is an investment. But that's just my opinion, and everybody's individual. So hopefully this gives you a bit of an overview of investing as a beginner's guide. You've got property, which is obviously purchasing houses. You've got stocks and shares, which is purchasing companies. You've got index funds, which is purchasing groups of companies. And you've got Bitcoin and crypto, which is purchasing tokens, which have a limited supply, which are digitally created. So which do you prefer? Do you invest in any of these asset classes at the moment? Please pop it down in the comments. I hope you've enjoyed this video. Please give me a big thumbs up and a like. I massively appreciate it every time you do that. And if you've enjoyed this content, please subscribe. I'll be putting out new videos every Monday, Wednesday and Friday, and I'll see you in the next video. Thank you so much.